In 1999, the transportation sector of the U.S. economy plummeted to the lowest levels in decades relative to the S&P 500. This was a major economic warning signal suggesting that the U.S. economy was weakening substantially during that period. Indeed, in February of 2000, the unemployment rate that you see on this chart began to trend up, ultimately leading to the 2001 recession. We saw something extremely similar in 1973, right before one of the most severe economic downturns in history, again with the unemployment rate beginning to rise shortly after a severe underperformance of transportation stocks. Now, fast forward to 2024, and we've seen one of the worst performance of transportation stocks since 1999. And as we've discussed in previous videos, the unemployment rate in the United States is already beginning to rise. Now, this is a pattern that we've seen several times over the last 60 years of data. Every time that the transportation sector weakens significantly, just like we're seeing today, we see a recession in the US follow very shortly. Consumer stocks have also been underperforming significantly over the last year. This is a chart showing us the performance of US consumer stocks relative to the rest of the market. And this move that you see here is the market telling us that U.S. consumers are weakening. A weakening consumer is something that we saw before the 2020 recession and before the 2008 financial crisis. We know that if the consumer is weaker, they're less likely to spend, which slows the economy down and increases the odds that the economy heads into a recession. We're currently in the process of seeing that happening. The only question is, how quickly is all of this going to happen? Now, believe it or not, we do have some signs that we have a little bit of time. This is a chart showing the performance of the financial sector relative to the S&P 500, and it's been performing quite well over the last few months. If we zoom out and look back on the last year of performance of the banking sector, we see it's remained quite resilient over this time period. Now, again, heading both into the financial crisis and into the 2020 recession, we saw the banking sector collapse into the downturns. So this resilience that we've seen over the last year is actually quite a good sign. The same thing is true for the home building sector, which you see right here. This is the performance of home building stocks relative to the rest of the market, and they've stayed incredibly strong over the last couple of years. Again, when we zoom out, we see typically heading into recessions, the home building sector declines. Home building is notoriously famous for being a leading indicator of the economy. So the fact that they've been strengthening here is not a recession signal. So what's the takeaway from all this? We do have strong evidence that we're nearing a recession in the US, but there are still parts of the economy that have yet to break. This could mean that we are in for another couple of months of mixed economic data before we actually see a full-blown recession. And we see that reflected in the S&P 500's price action. Yes, we've seen quite a bit of volatility over the last few months, but when we look at its key moving averages, they're still generally pointing upwards, which arguably means that there is still upside momentum because some parts of the economy are still holding up. If we go back to look at the price action at the top in 2008, you can see it was a lot weaker. In the topping process in 2008, the moving averages were pointing upwards in July 2007. But as the economy really transitioned into a recession, you started to see these moving averages curl downwards and the S&P 500 break decisively below them. We haven't seen this type of topping process in reversal form today. The exact same thing happened in 2000. The moving averages were pointing solidly to the upside in July of 1999, showing plenty of upside momentum. It wasn't until September of 2000 that you actually saw these moving averages begin to curl downwards and price decisively break below them, setting off the large bear market that followed. So today, while we've seen a lot of people flip bearish on the market during this last period of volatility, it could be that we still have multiple months of a topping process before the market actually heads downwards. What we're closely watching with our members right now is the general momentum of the market and whether or not the stock market is able to keep its aggressive upwards momentum. Because that's the big risk with flipping bearish too quickly on the market without any strong signals from a technical standpoint. Because the truth is, if no recession happens until, let's say, December of 2024, there could still be plenty of fuel for upside between now and then. Take the ISM PMI, for example. This is a survey on economic activity. When it's high, it means the economy is strong. When it's low, it means the economy is contracting. The last two readings on the PMI showed a clear rollover in economic activity, getting everybody very concerned that the economy is entering a recession. But when you zoom out and look at all of the recessions going back to 1970, we see that all of them see the PMI go below 45. Currently, the ISM PMI is still at 47, which isn't very impressive growth by any means, but it's definitely not recession territory. Take 1995, for example, that was exactly the same level as we are today. The S&P 500 was melting up during that period. In fact, the stock market continued to melt up in 1996 and 1997 because no recession ever materialized during those years. Now, that's not the scenario that we expect today, but it's to make the point that depending on exactly when the recession starts, the price action on the S&P 500 could be very different. Now, I want to be clear, a great chunk of our current allocation at GameOfTrades.net are bets that are going to perform well during a recession. We added utility companies that have been performing very well during this volatility. We have exposure to gold, treasury bonds, and we're actively scanning setups on other defensive sectors like healthcare and consumer staples. These are all parts of the financial markets that can still provide returns right up to the very edge of a recession, allowing us, and ideally you, if you're subscribed to a service, to benefit in this very difficult economic environment. So grab yourself a subscription to our service if you haven't already.